Hello everyone. I did in fact made a post which I don't many of you saw that I was gonna be making some changes on the channel. So gonna be resuming uploads on this my goal only channel. So on this channel I'm only gonna be dealing with goal alone. So I left up two videos, got some of the other older videos out. Gonna be doing majority of the tutorials on TradingView, but from time to time when I'm doing the live trades again and showing you guys how I get my entries, it will be on the MT5 platform. So here is the core model concepts part one for the gold trading algorithm. I'm gonna drop some gems as always. Hopefully can get this channel back up and running. I started on the vlog channel, I resumed on my main channel and now decided that it's full time. Come over right here to the current channel for gold. Okay, so only one that I have. So let us begin. First and foremost, gold is the most famous traded commodity apart from oil. Some persons trade it alone, and I can honestly see why. But it can be an asset that can trip us up if we don't know what we're doing. And in this algorithm tutorial, I'm going to just show you guys how, despite what many are being taught online, it simply boils down to understanding where the stop losses are and having a clear outline plan as to how to trade and not become the market liquidity. So today is Thursday. It's the end of the market cycle. So let me begin by going at the start of this trading week. So let us begin. I'm gonna do principles on the Sunday open and so on later on, but for now, I'm just gonna focus on the Monday open. So 1 hour chart. And let's get us the start of this trading week. And here we go. All right, first and foremost, depending on which day you're planning to trade, especially if you're just planning to start Thursday, Tuesday is the day most people tend to jump in. It is important that you understand that there are players that are already inside of the market. So what can we do? In the overall grand scheme of things, I'm seeing the overall structure of what the market price did. Notice I said structure, not market patterns or candlestick patterns, because the market maker doesn't care about that, right? No, this is where the week started, all right, by virtue of the Sunday, well, Monday open to be more precise. This is the highest and lowest area that the price has entered is being respected. And we also see that where the sellers entered, sellers are currently seeing some profit. The next thing you need to take a look at is where exactly the main players are in the market. So buyers, right? And their stop loss is here. And then we have sellers. Let's put a look arrow here just to emphasize that sellers entered here. And the sellers, their stop loss is up here. Cool, wonderful, perfect. The neutral point. We're at the equilibrium point of this entire move. Let's put the Fibonacci to help us pinpoint that more accurately. So right there. So we are just above the 0.5 or the equilibrium price zone area. Now, why is it important? Let's go on the smaller time frames and work our way down. Why is this so important? Well, simply put, we already understand that there are orders that have been placed here. There are orders that have been placed here. So we have a myriad of traders that are currently, quote unquote, in profit. But the question is just for how long? Once you identify on the chart where the stop losses are, then you start to understand what area the market maker is more likely going to target by virtue of which stops are going to be run and which stops have already been run in the liquidity sweep and the stops that are going to be run in the future. So for those who got in on this first leg, by the way, there's a lot of sellers that are currently in profit right now on this move. I mean, 1, 2, 3, that's a lot. For those who got in on this first leg, as I pointed out earlier, their stop losses are in this vicinity. Every time I put SL, I'm showing you the target or the typical areas where traders put their stops. Most go for 20, 30 pip stop loss. All right. Let's take a look at the bottom side now. So for each person who sell at the bottom, their stops would have been run by some local, by retracements. Sell at the bottom, stops get run, so on and so forth. So right here, so we would have seen that for those who entered a buy here, let's break this down step by step. Let's just put B for buy, SL, okay. These guys who entered in this vicinity, investors, their stop losses didn't get run. So what's happening? So if these guys who entered here stop loss didn't get run, the traders who entered here, they are currently also who went and placed a buy here, they are currently also in profit, right? Market price would have gone, put them in profit. Some would have collected. So more buyers, yeah, came through and are looking at this area. So now the target zone that we're looking at right about now in the overall grand scheme of thing, we're looking at these stop losses to be potentially run. Now, there are key elements to this analysis that has to perform for us. First and foremost, this is the previous impulsive move, which means that there are a ton of orders inside of this move. Work with me. I'm gonna go on the 5-minute chart now. Given that there's a ton of orders inside of this current move, what needs to happen for us, the investor, in deciphering whether or not we're gonna place a trade? And by the way, this would have been an okay entry for most. But for the long-term grand scheme of things, you are looking for that big payout. The long-term move in which you're looking for the stop losses of the sellers that are still in profit, those here and over here, you're looking for their stop losses to get run, correct? What is the visual confirmation that you're going to use to say to yourself, all right, I'm getting complete evidence that market maker price is making a grand push to wipe out the liquidity that is, the liquidity that is present in these areas. First confirmation that we're currently looking at this present moment is that market price is above equilibrium for the overall range that we established. But for this impulsive move, for you to visually confirm to yourself that the asset price is truly in fact going to continue, you have to see market price come above, break this line, reset this equilibrium area, and then continue to climb up further. You have two entry options available to you right about now, and I'm going to break down the two of them. Entry option number one. Naturally, let's talk about the one that you missed. First wave. The next entry option would be if price breaks back below equilibrium, respects the floor, and then re-enters it, you can jump in either A on this retracement or more precisely, right here, so it would be good because that would be a decent justification entry. Or you can simply wait for the break above equilibrium and then the equilibrium, or should I say the median point of this current previous bearish impulsive move. That's two options that you have. Follow me, so that's over it. Don't want to confuse you. There are two key levels that you can jump in on this trade. Obviously, jumping in right here is a big no-no. If you're jumping in right here, you're currently going to be jumping at a structural high. The market maker cannot break past this current level, right? This was where there was a rejection by the bull powers and price kept going down. So there are sellers at this area that reinforce the overall move all the way to down here. So it would be nice for us that the market price pull back slightly while respecting this floor. After pulling back, starts to climb. I'm going to dry it out. Yeah, pull back, starts to climb back again. You guys can jump in on one of those retracement areas. The next one is the big 5-0, the big 50. Price break above, respects the level on the retracement, starts climbing impulsively. You jump in on one of those legs. You can place your stop loss below equilibrium once you get a break, or if you decide to enter below equilibrium right here, so you can place it at the low, right? But wait for the pullback first. Under no circumstance should anyone be caught buying at the top of an impulsive move. You're buying when majority of traders are going to be collecting on their short profit that they just made on this first leg. And if you buy up here, your stop loss is in direct firing line for the market maker to sweep down and run your stop. All right. So that's one of the core basic principles that you have. Can't really reinforce that any harder. It's all about time, price, and understanding what the market is doing. The best entry time frame that I recommend is the M1 chart. However, some people are more comfortable on the M15 or the M5, whichever one works for you. Now, once you have missed a move, there's nothing you can do but wait for a next opportunity to present itself in the overall push. We already understand that gold is on a corrective structure right now. It's aiming to take out this high and then go back to the high that it made for 368 if memory serves, right? Now, in the event that Friday comes on the scene, we have to be careful because given that the market cycle is coming to an end today, Friday is a stop hunt day and it's gonna be meant to trap a lot of traders over the weekend. So if you hadn't, and to be honest, this was a week. I'm go back to the 1 hour chart. This was a week for both buyers and sellers if you're taking a good look at how gold perform. So gold gave both buyers and sellers equal opportunity. But for those who are on the buy side, who are holding out long term, you stand a much better chance because as I pointed out, we're looking for the market maker. Provided that he respects the level, we're looking for all these stops in this zone to be run. All right. So that's it for now. Hope you guys enjoy this basic algorithm tutorial. I'm going to be live streaming on this channel a lot more often coming up, God willing. So please share